Hey, welcome everyone. Tom here from Park Avenue Trading, your chief dealer on a Saturday morning. It is, what date is it today? It's November 9th, 2024. And just going to have like a little discussion with you because I've been talking to some of the people that are in my trading group, and they really question like why I never like use moving averages. And I have to say that it's just that I never, it's not that I never used moving averages. I had used them in the beginning of my career, and I kept getting whipsawed with them constantly. And I have some questions for you guys, and perhaps you can answer them in the comments. If you do use moving averages, how do you use them, and what you find to be the best? But I'm going to offer you an alternative in this video, and it's going to be kind of controversial. And no, this is not a Bud Light can. I'm putting the I'm putting the microphone close to my mouth because it doesn't seem to really uh, get my voice strong enough. Sometimes I watch videos and I go, I can't even hear that video. It's so annoying. So I just bring it closer to myself and make a stronger volume. So, you know, since the late 1960s, early 1970s, um, moving averages got really popular, and they became very popular in the 1970s because markets were in an extremely inflationary and trending market. So for many years, moving averages have been one of the most popular methods for trend following. And the reason why was because they were working in the 1970s, and they kind of like got a lot of folklore, kind of like Gann and these other like market gurus and all these different techniques that are just like on every chart that you can find in every application out there. They're there. So I want to like really talk about that because they became really popular because of the straightforward construction and ease of interpretation. But however, their effectiveness relies heavily on the market's ability to trend. And my research shows that markets often fluctuate within trading ranges, trending only about 20 to 25% of the time. Now, you could say, well, what are you talking about? I trade 10-minute charts, and there's trends, for 30 pips, 40 pips. That's not what I'm talking about. What I'm talking about is an overall longer term market trend where we're looking at, you could look at weekly charts, but then like if you're trading a smaller time frame, you should be looking at daily charts because you really want to trade with the main trend. Okay, you could trade against it all you want on a small time frame. I'm not saying that, but for the argument that I'm having here is that I'm saying that overall markets only trend about 20 to 25% of the time on the bigger time frames. Now, historical data, and you could do your own analysis on it, but historical data indicates that approximately 75 to 80% of the time, the price of a market remains within a trading range. Now, you have to define that range, okay? And this is where, there's no certain set of like points. You have to define the range for yourself, and that will help you immensely. Because let's say, for instance, you just define a trading range to be 500 points. So from top to bottom, you mark off from the top to the bottom 500 points. You go, that's the trading range. Okay, now you could also do it by going back in time and looking at highs and lows on a weekly, and then basically saying, okay, the high has been this, the low has been that, and say it's like 12 big figures or something. You can go, okay, well, I want to work within 12 big figures. So I'm going to say, since I'm a short-term trader, I'm going to divide that by 3. I'm taking, a division by 3. So I'm going to say 400 points. And these are some rules that you have to come out with. But prices, here's the interesting thing, is that prices tend to accelerate roughly 2 to 2.5 times faster in a downtrend than prices tend to increase. So when a marketplace is moving upward, it's much slower than when a marketplace is moving downward. So that's why the bears, and I happen to be, I love bearish markets because they do move quickly, and I don't have to sit and wait watching paint dry when I'm long. Now, it doesn't mean that I don't take long positions. That's not the case at all. I do take long positions, but I'm just well aware of the fact that bullish marketplaces tend to take a lot longer to move. Now, why? Well, if you think about it, think of traders. They basically build positions gradually. They don't ever take their largest position at the first point. They basically say, okay, I'm going to buy 1/3 of my position here, moves up a little bit, I'm buying another third of my position, and then it's moving higher, I'm going to buy another third of my position. And the marketplace is slowly grinding up, and they're watching it, and then all of a sudden it starts turning down, and they react very quickly when the market price drops, often like just squaring the whole thing immediately. At once they get rid of the position. So I have some questions that I want to ask you, and then I'm going to go over what I think is something that you can use to determine what would be better for you. And it's basically a band. And I'm going to give you some ideas, and you tell me like what you think of it. This is basically just an open conversation I'm having with you, and I'm having it in my mind as if you're standing in front of me. So the most basic calculation of moving averages is just arithmetic, right? It entails summing the closing prices over a security over a designated period, dividing this total by the number of entries, and plotting the result on a chart aligned with the price intervals. Now, while this method's common, and that's how they do it, it's not necessarily optimal. Many market timers overlook the critical question as to why is each time period weighted equally? When the most recent price activity, what's going on right now, is much more significant than what happened 15 bars ago, or 20 bars ago, or 10 bars ago. Additionally, why is the average plotted directly below the last price of that entry when it's calculated? Again, the most significant is what's happening right now. So that's a question I have, and I would like you guys to answer it if you can. And now, my experience, this is just my experience, the outcomes from using traditional moving averages are no more favorable than anything else. They're no more favorable than any other trend following strategy. Now, while moving averages are easy to calculate and they're widely available on everything, this widespread acceptance does not guarantee utility or trading success. In fact, I found that the more acceptance and usage usually correlates with really poor performance results. So that's the question I have. I know that there are really, really great traders that use moving averages. Paul Tudor Jones basically he says one thing about the moving average, and he doesn't really say anything more about it. He says that the 200-day moving average is the most important moving average you can look at. And that's a very long moving average. And he says once a stock price or an index breaks below that, it's going into bearish territory. And, it doesn't really necessarily mean you have to sell it right then and there. But what you have to start to do is you have to look at market structure. And you have to go back and look at the last previous high. And you have to really look to start selling the market at that price high or close to that price high. And if it goes beyond that price high, you know, you got to look for the next price high to average your sales in with the ultimate stop at the high. Now that could be, you know, for people with shallow pockets, that doesn't work. And I'm going to show you something. I'm going to talk to you about something right now. Over my many years of trading, I've noted that price activity fluctuates within a band. And the band that I came up with was defined by, if I take the price, the low of a day, say if I go back and I find a 10-day low, and I multiply that low by 110%. Now, of course, you got to adjust. It's not 100, you know, it's 0.0110 for currency. I found that once I project that up, I have an upper level of what I could be looking at for an overbought condition. I don't even like to use the word overbought and oversold because I don't really think it truly exists, and that's for another video. But really what I'm looking at is I'm looking for a measured move to basically say, okay, up in this area, I'm looking for a high that I could sell that will help me get back down, because there's a market law, and market law basically says that a bullish rally will usually continue up until the beginning of the bull move. Now, again, that's for another video, but if you think about it, what the market law or the principle is saying is the market makes a low, it's going to start to retrace higher. Now you can use Fibonacci levels. So basically what you're looking for is the 100% retrace of the fib. That generally doesn't occur. What generally occurs is that it will stall between 0.618 and 0.82, which I call the coffin box. Now, if it gets through the coffin box, then the next level is the 100%. Okay, so that, again, that's for another video. But I've noticed that there's a tendency for price activity to fluctuate within a band. Okay, as I was saying, I decided to jump on the chart because it'd be much easier to continue with what I was saying. I've noticed that price activity, because most of the time it is in a trading range, fluctuates within a band of about 4%. Now, precisely, I'd say it's 3.8%. So about 4%. You can use 4%. So what I'm saying is that I could take a market high right here, and I can multiply this high 128.93, and I'm going to multiply it by 0.04%. So hang on a second. Let me do that for you, and we'll put it up. Okay, so when I do that, when I take the 128.93 and I multiply by 4%, I get 5.15 big figures. And that gives me the price of 123.77. 123. Come on. Okay, 79. That's close enough. So this is a daily chart. So basically what I'm saying is that this marketplace at this time right now is in, in what you would consider an oversold condition. So if you were trading the day, like the hourly charts or the 30-minute charts or whatever you trade, okay, so you would have this price point mark. Now, where would we say that, this is the top, this is 100%. So 4% straight up right here is going to be right there. So basically the movement back upward, okay, this is the area of selling again the sterling dollar, because you would have basically your 4% level up here. Okay, so the marketplace, as it approaches, now this is where it gets a little bit kind of nebulous in a way. You say, okay, wait a second, it didn't go all the way back up there. No, it's not. So you could actually say, okay, if I am using 4%, can I use 3 as a means of like where it's potentially going to exhaust itself. But we could see that this right here is what I call a sell envelope right here, because this, if I take the top and the bottom of this bar, this whole thing is a sell envelope. Now I go over that in Tower of Price, and it's a great course. I'm not suggesting that you go and buy it or anything, but it is a good course, and I basically address that in that course. So if you notice, like, let me just do this. Let me get hang on here a second. Put a level here, right? And then we get another one there. That's basically, this is a whole sell envelope right here. Okay, ultimate stop is above this, but as we said before, marketplaces are in a trading range about 80% of the time. They trend about 20. So this market would have gave you an excellent area to sell, okay, just by using this 4% right down. Okay, now you could say, okay, the market does retrace. Once it breaks this, okay, now we have to take a new calculation. All right, it broke the top. It's saying potentially higher, right? So we need to take a new calculation. We know that this 4% low here held. All right, so we know that level held. Now, what do we look at? Well, we could look. You could go and you could do market structure. You could take, another measurement. You can go off of this retrace, or you could go, if I really want a higher level, I can go off of this retrace. If I take 126.18 and I multiply by 4% and I add it in there, I'm gonna get 131.22 is the next level that I should be looking at for it to kind of stall. And the high was like 130.45. Let's just leave it 131. Look at that, 132.66. But we had the upper range. If I take this, okay, and I want 131.22. 1.3122. Throw that in there. There it is. That was the upper band coming off of I think this low, 126, right? So that was the upper band. We said this was overbought at this point, or the overbought idea, right? So marketplace falls back down into it. Now, here, we'd have to take this high and throw down, again, 4%. But as you can see, the level itself is giving you an idea, like, okay, it's not, it's definitely better than a moving average. But, it basically told you that this was overbought. It came back down. But markets that are in bullish tendency tend to stay overbought for a long time. So, like I said, it's not perfect, but it's just an idea that you can use to try to basically get better levels to buy and sell. What I have to worry about, 10 bars, what should I use? High, low, exponential, non-exponential. It's just a simple calculation of 4% as a band. And here it is. It's not, this basically tells you, the bottom worked out great. The top, okay, once we broke it, not so much. I mean, it created confusion, but then you need to use other tools. I'm not saying that, you're talking out of both sides of your mouth. No, I'm just pointing out that basically this is what happened. And let's see if we go for this bottom. That's 126, 127.52. Let's take 127.52 since we're having, fun with numbers. 120. It says 132.62. So, well, I actually pinned this top right there. Came off, and then marketplace again moved up. Let's see if we take this low. What the heck? Why not? 130. $135.20. It didn't quite make that. I went to 134.50. But that's the idea, okay? And just using bands. Now you can play with the averages, the percentages. You could use, if you say, I'm only trading, 1 hour charts. Well, try 2 hours. I'm trading 4-hour charts. Well, try 2 hours. 2%. I'm sorry, not 2 hours. 2%. You know, oh, I'm trading dailies. Well, then it's 4%. Okay. So that's just the idea I'm throwing out there. Tell me what you think of it. You know, nothing works perfectly 100% in trading. You should know that. If I had something that worked 100%, you know, I'd be really, where would I be? I'd own my own private island somewhere, and just enjoy just trade, you know, whenever my 100% indicator said to do it, and I would have the challenge of trading, which I really do enjoy. I really enjoy this. So I look to see you guys on the next video. Please like and subscribe. Also, go over to Park Avenue Trading, get yourself a free ebook, join my mailing list. I send out some really cool emails. And remember, always enjoy the party, but dance near the door. Cheers.